Welcome to Home Biz Tax Talk. My name is Lysandra Everett. I am the Home Biz Tax Lady, where I help home business owners win the tax game. Home Biz Tax Talk airs Monday through Friday, and when you tune into my show, you're going to hear about topics that are important to the home business community. All right, so today we're going to talk about how to pay yourself as a sole proprietor, okay? I really get this question a lot. And so first, and I've also done other videos on this, but this one is going to be just a tad bit different because we're going to start with the nots. Let's talk about what you are not. As the owner of your sole proprietorship of your business, you are not an employee. You do not go on payroll. Even if you have other employees that are on payroll, you are not one of them, okay? Number two, you are not a 1099 contractor. You are not hiring yourself as a contract worker in your business, okay? So no, you do not issue yourself a 1099. The other thing is that your salary is not a tax deduction, okay? You do not subtract the money that you pay yourself from your profits. That is also a not, okay? So I hope I've covered the nots. So when you file your taxes and you compile all of your income and you deduct all of your expenses, whatever is left over as profit is really what the IRS considers you to have paid yourself. So you pay self-employment tax on that profit. So if you earn $10,000 and you've got $4,000 worth of expenses, that what's left over is that $6,000, and that's what the IRS looks and says that, hey, you paid yourself $6,000, okay? So that is the short version. Now, let's talk about the structure in this, okay? Because one of the things that you have to have in a business is structure. Do not use your business as an ATM. Okay, you really need to be structured in how you pay yourself. Now, I recommend that first off, when you get paid, when you earn revenue, that you set aside, you reserve 30% for your taxes in another account, not your operating account. And I know people like, oh my gosh, Lysandra, that is so much money. Okay, well, if reserving 30% for taxes is too much money, then you need to go make more money. Okay, this is a non-negotiable for me. Okay, point blank. End of story. It's a non-negotiable. So you set aside 30% of your income for taxes. And then I also, make a recommendation of 30% of your revenue to pay yourself. Okay. So if you make $100, you set aside 30% for your taxes, then you set aside 30% to pay yourself, and you use the rest to operate your business. Because one of the things that a lot of sole proprietors run into is having a broke business, because we're just paying bills and then we're just taking money out, and then there's no money left to run the business. So we're in this endless cycle of going into debt to run our businesses. That's not where we want to be, okay? Yes, you might go into debt to start a business, but that's where you start and not where you stay. And so with proper money management techniques, which means paying yourself a reasonable amount, also leaving money in your business for it to run, this is good money management skills, okay? And then at the end of the year, if you have made money in your business, which that is the goal of business, which is to make money. So if you have a profit, thou shalt pay taxes, okay? That's the way it is, all right? So with that, if at the end of the year you have too much money, okay, that's awesome. All right, because that means that you can pay your tax bill, and then you might have some left over. Do you know what you have when you have money left over after you pay your taxes? You have choices. You have a choice of what to do with that money. You can reinvest into your business. You can put it into a savings account, do absolutely nothing with it except invest it, or, put it into a retirement account or whatever. You have choices of what to do with that additional money. But if you don't discipline yourself to save that money for your taxes, then you're really and put yourself at a disadvantage, because now you're scrambling with how to pay. And so this is why, it all kind of goes in together. Now, when you pay yourself on a set schedule. This is what I mean by don't use your business as like an ATM. You pay yourself on a set schedule. So if that's going to be weekly, if it's going to be, every 2 weeks, twice a month, whatever, once a month, then you set that schedule. But what you want to do is keep it on a schedule. You don't want to pay yourself on Monday, then come back and pay yourself on Wednesday, then come back and pay yourself on Friday. No, that's like going to the ATM. That's not what you want to do. Think about how you would pay an employee on a set schedule and then pay yourself that way. All right. Because these are the disciplines that if you establish them in the beginning, then as you grow, it will not be such a difficult transition. Because, I've seen it where people have a really difficult transition with paying themselves if they haven't established the disciplines in the beginning. So yes, when you get in that revenue, yes, you take that 30% for taxes for your revenue right off the top. Yes, I do it. I do it religiously. Okay. So I know how it feels to slice that off the top and go put it into an account that doesn't get touched. Okay. It's the cost of doing business. All right. Now, the next question I get with this, well, how does this change when I go from a sole proprietor to a single member LLC? It does not change. Okay. For tax purposes, if you have a single member LLC, you are still treated as a sole proprietor. So nothing changes here. Your taxes don't change or anything. A single member LLC provides liability protection. It provides a separation for the business in its identity, whereas a sole proprietor, you and the business are one and the same. So the way that looks is with a sole proprietor, when you die, the business dies. Okay. With a single member LLC, that business is separate. And so that business can be sold and, do other things with it. So that's the difference. But, structurally, it's still the same thing. Okay. You transfer your money. Now, listen, you do not pay for your personal expenses out of your business account. You transfer the money that you pay yourself from your business account to your personal account. Okay. And then you pay all of your personal bills, whether that's your mortgage, your, groceries, gas for your car, whatever, that comes out of your personal account. So you either write yourself a check. I'm a paper check. I write myself a check. Okay. And then I deposit it into my personal account. But, you can do a bank transfer. That's absolutely fine. But the thing that I want you to keep in mind is that you do it on a set schedule and do not commingle funds. Commingling is when you're paying for business stuff out of your personal account and your personal expenses out of your business account. Do not do that. Okay. That's commingling. And where that gets to be an issue is, if you either get audited or if somebody sues you, and you've got all this money mixed together, then there's no reduction in liability. That actually, if you have a single member LLC and you're commingling funds, then that negates your the liability protection that LLC offers anyway. So don't do it. Establish the disciplines even if you don't have a whole bunch of money. Establish the discipline of setting aside the money for your taxes, paying yourself into a separate account on a set schedule. Okay. If you don't like how much money you're making, that means you need to go make more. You don't rob your tax account just because you run out of money, because you're still gonna have a tax bill. Okay. And so I have people that debate me on this issue, and I simply get down to this. When it comes down to filing your taxes, you want to be able to write the check and keep it moving, because at some point you will have estimated tax payments. If you are in the business to make money, at some point thou shalt pay quarterly taxes. And when you have a tax bill, okay, and you got quarterly taxes, your annual liability and your Q1 are due on the same day. Okay. This is also why I tell you to make sure you file in February. So if you do have a tax bill, you got a little bit of wiggle room. But once you have estimated tax payments, that first 6 months of the year is when you're writing the most checks to the government. Okay. And especially if you live in one of the 43 states that has a state income tax. Yeah, you writing checks to your federal government and the state. So this is why I say set that money aside so that when it is time to write those checks, you've got the money and you're not worrying about how you're going to pay that tax bill. And like I said, if at the end of the year you've paid your taxes, you paid your annual liability, you paid your Q1 taxes, and you got some money set up for Q2, then you got choices of what to do with the rest of the money. You got choices. Money buys choices. I like having money that gives me choices of what to do with it. Okay? So if you establish these disciplines when it comes down to upgrading, if you need to upgrade equipment, if you need to travel, for business or whatever, you have this money and you are not continuously going into debt to service your business. Okay. Just humor me and try it. All right. Humor me and try it. Okay. So listen, thank you guys so much for tuning in to Home Biz Tax Talk. Again, we air Monday through Friday, and you can schedule a consult right here to get your questions answered. All right. Have a great day, and I will see you all next time. Bye.